Hi guys, welcome back to the Financial Interest YouTube channel. My name's Dan. So in this week's video, I'm going to cover how to read a cash flow statement. So this is the third part of my financial statements series. First we covered the income statement and then we did the balance sheet. And now we're finishing up with the cash flow statement. So let's get on with the video. So first let's take a look at the definition of cash flow. So according to Investopedia, cash flow is the net amount of cash and cash equivalents being transferred into and out of a business. So the cash flow statement is split into three main parts. First, we've got the cash flow from operating activities, then we've got the cash flow from investing activities, and finally the cash flow from financing activities. So first we'll go and look at the cash flow from operating activities. And what we'll see in this is where the company makes its main money from operations. So this is where you'd expect to see the majority of the money coming into the company. And this is for just the day-to-day running of the operations, the business money that's coming in versus the money that's going out to run the business. So we can go look at the cash flow from operating activities. And what we'll see here is first the net income, which comes from the income statement. And then we need to adjust for the non-cash items and also adjust for changes in working capital. So we'll go and take a look at an example from Apple here. Okay, so here we are with Apple's cash flow statement. So the first thing we see at the top is the operating activities, or the cash flow from operations. So this is really important because it shows the money that we're making from our main operations. And we've got obviously the money flowing in and out of the business, which is over the period of the last year. And this will show us the short-term assets and the short-term liabilities. So that's every transaction that's kind of happening within the last year. So at the top here, we've got the starting balance, which was $50 billion. And then we take the net income here from the income statement, which is $57 billion. And as we move down, we need to reconcile basically the non-cash expenses. So depreciation and amortization, this is a non-cash expense. It's recorded on the income statement and the balance sheet, but it's not a real physical change in cash of the company. So if we take this amount of the 57 billion and then you work down and add these things in, so you add in the depreciation, amortization, the share-based compensation, minus off the deferred tax, because that's what you will see in brackets, the things that you need to deduct. And then we get to the change in the operating assets and liabilities. So we need to adjust this as well. And then what we end up at the bottom is the cash generated by operating activities, which we can see here is just over $80 billion. So what we also need to remember here is that the net income, which is showing the $57 billion, that's not actually the same as the amount of cash that we've got, and that's due to the accrual accounting system that most businesses use. So what this means is that a sale or a purchase is accrued or recorded when the order confirmation is made, rather than when any cash is actually physically received. And the same is true on the flip side of that when we're actually paying out money. So that needs to be considered as well when we're looking at the cash flow statement. So at the bottom we can see here we've got $80 billion, which is cash generated by the operating activities. And this is a really good number because it's also more than the net income amount. And obviously it's really important that we have a positive number here because it's from this cash flow from operations, the running of our normal business, which is where we want to see all the funds and cash to actually reinvest back into the business. And if this number is negative, then we've got a real problem. So obviously if the business can't fund its own operations, then it's going to need to take out debt, which is not what we want to see as well. And moving down, we'll look at the cash flow from investing activities. So what we can expect to see here is the purchase of property, plant and equipment, and that'll often be the capital expenditure. And on the flip side of this, we'll have proceeds from the sale of property, plant and equipment as well. So this is in the case if we're selling buildings or we're selling equipment, the income of money would be shown in this. So you have to always think about it. We've got money flowing in and money flowing out. So we could acquire other businesses, which would be money flowing out, or we could sell internal businesses that we already own, and that would all be shown on the investing activities. And another thing would be the purchase of marketable securities, such as bonds and things like that. And then at the same time, we can receive proceeds from the sale of these marketable securities as well. And one of the main things that we focus on in the investing activities is the purchase of property, plant and equipment, because this is the capex, what we're going to spend to reinvest in the business to kind of maintain it. And this forms part of the number that we need to use to get the free cash flow, which I'll go over a bit later on. So here we can see the investing cash flow for Apple, and this shows us the long-term assets which we're purchasing or selling. So here we can see the purchases of marketable securities, and Apple have paid out nearly $115 billion here. And then they've got the proceeds from marketable securities, which they've made back here. And we go down here and we see the payments for property, plant and equipment, which is $7.3 billion. And this is an important number because this is the capex. So the capital expenditure of the company is what we're using to maintain the day-to-day operations of the company. So that's buying new machinery, maintaining the existing machinery, just everything we need to do to ensure that the business can run day to day. And this is an important number because it features in the free cash flow, which we're going to go on to a bit later on. And we can see here, if we look at the total, that the net amount is actually minus 4.3 billion nearly here. And it's actually not a bad thing because it's obviously we can see here that the company is actually investing back into the business. So this is kind of not a bad thing to see. It's always good to see the investment to keep the business running and to actually grow it as well. And we'll also see here if any acquisitions are made by buying another company, and also if any companies are sold off, or if any of our other assets are sold off, that will appear in the investing activities. So moving on, we get to the cash flow from financing activities. So in the cash flow from financing activities, we're going to see money that we bring in if we issue stock. So that's an equity. So that would be money coming in. At the same time, if we repurchase our own stock, that would be a money flow going out. The same for paying dividends to the shareholders, that's an outflow. And then also we might be taking on debt, and that would show up in the cash flow from financing. So this would be money coming into us in the form of perhaps a bank loan. And then also from here, the repayments of debt would feature there. And this is like the long-term debts. And then also any capital or finance lease payments would show up here. So now if we look at the financing activities, we can see all the money we've got coming in and going out here. And this shows everything relating to the long-term debt and also the equity in the business. So proceeds from issuance of common stock, that's the company's raising money from selling more stock, so that's related to equity. Then we've got payments out for taxes, payments out for dividends, and a quite large amount of $72 billion, which is repurchase of stock. Now, repurchasing of stock is one of a few ways where we can return value to the investors. The important thing here is that Apple are actually repurchasing their stock when it's not over the intrinsic value, because if the company is overvalued and they're repurchasing their own stock, then that's not a really good way to actually spend the money, because the company is overvalued. But if they're repurchasing it when it's below the intrinsic value, that's kind of returning good value to the investors as well. And then we can see here there's any kind of payments related to debt. So repayments of debt here, we can see that's 12.6 billion. And then we have various other things like the proceeds from issuance of debt. So that's taking on more debt. We can see that's amount of 16 billion. So we can see the net difference here is nearly $87 billion from the cash from financing activities. And then we can see here the total deficit, which is $10 billion. So that's how we end up with the closing position of $39.8 billion. So if we go back to the top, here we see the starting position of 50 billion. Then we're adding the 80 billion, removing the 4 billion here and removing the 86 billion here. And that is actually takes us to a total spend of 90 billion roughly going out. And then we can see that that's a 10 billion change in the cash position. So we can see here that one of the important things we need to look for is the change in the operating cash flow over time. So we can look back here, we can see it's 77 billion in 2018, 69 billion in 2019, and 80 billion in 2020. But what another important measure is here is the actual free cash flow. So if you look at the definition of free cash flow, the free cash flow represents the amount of cash a company has left over after paying out all of its expenses to run its operations and maintain its capital assets. And the actual formula for the free cash flow is the operating cash flow minus the capital expenditures. And the reason why free cash flow is so important is that this is the total amount of money we have available to put into other investments. It's always good to think about it as if you're the sole owner of the business. If you've got an amount of money left, you've invested everything in capital expenditure to keep the business running, and this is the total amount that you've got left in your pocket. So you can then spend that on anything you want to. You could spend it to further buy more equipment, to grow the business. You might return it to shareholders in the form of dividends. You could repurchase your own stock and things like that. So this is really an important measure because it's all about cash. And it's also a good measure to actually check this and see how this is growing year on year. We'll take a look at an example from Apple where we'll see the 2018, 2019 and 2020, so we can compare the amounts for that. And what we need to do for the free cash flow is take the cash generated from the operating activities, which is the 80.67 billion here, and then we need to remove the capital expenditures, which we can see here, which is property, plant and equipment, which is the $7.3 billion there. And that leaves us with a total of $73.36 billion as the free cash flow for Apple for 2020. And what is also really useful as well is to look at how that has changed over time. So I did a quick calculation on these before. So we've got the 2018 free cash flow is the 77.43 there. And then we just need to minus the 13.3 there, which gives us 64.1 billion. So moving into 2019, we've got the 69 billion there, and then we're minusing the 10 billion there, and that gets us to an amount of 58.89 billion there. And obviously we just mentioned for 2020 we've got the 80 billion there minus the 7.3 billion there, giving us a total of just over 73 billion in free cash flow. And it's always good to actually look at over a long period of time if you can. Ideally, I would say 10 years is a good amount, so we can see the change in free cash flow year over year. And actually the free cash flow should be a good representation of how the company is growing as well. So if you think about it, then you've got a total amount of, if the company is growing their cash amount by 60 to 70 billion a year, it makes logical sense that the company should actually be worth at least the 60 to 70 billion more per year in its valuation, because that's actually the amount they've got sitting in cash. So having a really good free cash flow means that we're able to fund any growth of the company with the cash we've already got. So this is really important because a lot of companies, they'll try and grow the business through taking on debt, and that's kind of, it's fine when the kind of interest rates are good, but this could be kind of really a big problem when it comes to like changing in interest rates or when there's a recession. So now just to show an alternative example of a company that's in a bit more problems than obviously Apple, we'll go and have a look at Boeing. So we can see here with Boeing that obviously they've had some problems, and over the last few years they've actually had a net loss. So we can see 2019, we've got here 636 million, and then to 2020, like, we've got nearly a $12 billion loss. So this is already the starting point, and we look further down here at the net cash from operating activities, and we see that this is like negative $18 billion, and we can see that the year before was also negative. So this is really a big red flag to look out for here. So we can probably fairly assume from looking at this that they must have taken on debt in order to keep their operations running. So if we go down and look at the net cash from financing activities, we can see we've got an inflow of $35 billion there. So net borrowings here shows $47 billion. So this is money that they've had to borrow to actually keep their operations running. So this is clearly a big problem, and like, this kind of company you should really avoid. And now let's look at some of the key points. So what we want to see here is the operating cash flow should be positive and growing year on year. And ideally, we'd like to see the operating cash flow higher than the net income. And also we want to see that the free cash flow is positive and growing over time. We also want to avoid companies where the operating cash flow is negative, because that means that we have no money coming in from the general operations of the business. So if that's a long-term trend, the only way we can keep the operations running is by taking on more debt. So we need to be aware as well of declining operating and free cash flow. And we need to carefully monitor the amount of debt being taken on by a company. So that's it for the video. I hope you enjoyed it. If you did, please give us a like, and also consider subscribing to the channel. It would be a big help, because I'm just trying to grow the channel to more viewers at the moment. And also remember to hit the bell icon for notifications as well of when I release new material. As I mentioned earlier as well, I'll leave the links to the previous videos in the financial statements playlist in there as well. So thanks for watching. I'll see you in the next video. Cheers.